Hey everyone, welcome back to the show. Thanks for tuning in. My name is Mike, this is my whiteboard, and today we're going to be talking about 3 strategies that I believe every beginner trader should learn first. So if you missed yesterday's segment, we talked about 3 concepts, and today we're going to talk about 3 strategies. And I really focused on really looking at certain strategies and mastering them first before learning about other ones. So we're going to talk through 3 of them today, and I think it's going to be a good starting point for those of you that are just getting into it. So let's get on to the first slide and we'll talk about our first strategy, which is really just naked options. Like I said yesterday, if you learn the fundamentals and you master what happens when you sell a put and what happens when you sell a call, or what happens when you buy a put or buy a call, it really puts you in a better position to be able to create complex strategies and combine those certain options to create certain strategies. So there's a few benefits why I believe learning about naked options first is going to be helpful. And really what we want to do is learn why selling options increase probability of profit. So when we talk about probability of profit, all we're really talking about is the probability of making at least 1 penny on the trade. So when we're selling an option, we put ourselves at a better position and a better and higher probability of success than if we're buying options for a few reasons. So if we're looking at this option strategy right here, which is really just selling a naked put that's out of the money, because an out of the money put is below the stock price, because ultimately we're selling the right for someone else to sell their shares to us. So ultimately, if I'm selling this option here, I have the ability to become long 100 shares of stock for every contract that I sell at whatever strike I choose. So one of the benefits of selling a naked option or selling a put in this example is that we have multiple ways to be correct. If I'm buying an option, I need that option or I need that stock price to move past my option and move that option in the money to be profitable. Because if I buy an option at a certain level, I need it to gain value over time, over a specific period of time to be profitable. But the opposite is true with selling an option. So what I can do is I can sell a certain strike, and I actually have multiple ways to be successful. So what I want to happen when I'm selling an option is I want that option to expire out of the money. So let's say I sold this out of the money put for $1. What I want to happen is I want the stock price, which is this little blue symbol here, to stay anywhere above this range here. Because if my option expires out of the money and I sold that option for $1, it's going to disappear from the account at expiration, which allows me to keep that $1 that I collected as profit. So really, I've got 3 ways that I can be successful. I can be successful if the stock price stays right here and the put goes through expiration and expires worthless. I can be successful if the stock price goes up, and that's really going to be ideal because it's going to move the strike further out of the money or further away from the stock price, which is going to reduce the value of that option and potentially allow me to buy it back before expiration at a lower price. Or the stock price can even go against me here. So even if the stock price goes down, which is not what I would want to happen, but it can actually go down a little bit as long as it doesn't go down past my strike. When it goes down past my strike, that's when I would potentially receive less profit than that $1 that I collected. And the further down it goes, the more and more I'm going to be getting into that loss territory. But as long as it stays anywhere above this put strike, I have the ability to reach that maximum profit. And really what we're doing with that is we're not betting on direction, we're actually betting against direction. So basically what I'm saying is I don't believe that the stock price will breach my short put at expiration. So instead of thinking of I'm selling a put, I need that stock price to go up, really what I'm doing is selling a put and saying I don't believe the stock price will breach that strike. So it actually gives me more leeway and it gives me 3 different ways to be successful. And another impact that we have with naked options and selling naked options is that credit that we receive. So since we're collecting credit, it actually improves my break-even point. So whatever this strike was, let's assume that this strike was on a 50 strike. So I sold a put on the 50 strike and I sold it for $1. Well, now the stock price can actually go to 49 and I'll still break even because I collected $100 or $1, and I'm able to use that collection to offset any losses I would see at expiration. expiration. So if the strike's at 50, I can actually break even if the stock price goes below that to 59. So that's another great benefit of naked options. But we're going to go on to another strategy which combines a naked option with a long option, and it's just your simple vertical defined risk spread. So why do I believe we should learn about these? Well, really, learning about how defined risk works is going to be imperative when you're learning about other strategies such as ratio spreads or iron condors or jade lizards if you're familiar with the Liz and Jenny strategy. And really what we're doing here is just adding on a long option that's a little bit further out of the money. So let's assume that I was able to sell that same exact put for $1. Now what I would do is go further out of the money and buy a put to define my risk for, let's say, 25 cents. So what happens here is we obtain a smaller net credit. So if I sell a put for $1 and I buy a put for 25 cents, I have a net credit of 75 cents. But still, I'm going to have a much higher probability of success. I still have the same situation going for me. So the stock price can go down a little bit, it can stay the same, or it can go back up, which means we still have 3 ways to be correct. And really, the difference between defined risk and undefined risk is the fact that your risk is defined. So the stock price can go well below my long put there, and really what's going to happen is nothing. I'm going to be defined risk at that long strike because of the fact that if I know my short put will turn into long shares at expiration, then that must mean that my long put would turn into short shares. So any losses that I would see on my short put would be completely offset by my long put as well as we're going down below that strike price. So what we can do is define our risk, which is really good for smaller accounts, specifically accounts that are maybe under $10,000 or around $5,000, where we want to get into those higher priced underlyings like Google and Apple and Amazon, but we can't have the ability to sell those naked options because of the buying power that it would take. So what we can do is define our risk, and it's especially good for IRA accounts. So IRA accounts have the ability to sell things like naked puts, but they're actually cash secured. So what that means is if I sell a put at the 50 strike, it's going to take all of that value. So it's going to be requiring me to put up $5,000 less the credit received for every contract that I sell. But if I create a defined risk spread, it doesn't require that much. So if I sold this 5-point wide spread and I collected $1, it would only take about $400 or $500 depending on your brokerage to place that strategy. So it's a pretty huge difference, and that's why I like to use defined risk spreads a lot in my personal IRA account. But we'll go on to the next slide here and we'll talk about another strategy, which is just creating a neutral range-bound strategy. So as you can see, we're just layering on. We started off with the short put and we added on a long put to define our risk. And now we're looking to sell a credit spread against that, which really creates a neutral range-bound strategy. So the importance of this is really just learning how ranges work. An interesting thing about this strategy, which is an iron condor, is that one side you might see lose while the other side you might see win. So throughout the life cycle of the trade, let's say the stock price goes down. Well, you're going to see your put side as showing a loss, but you're going to see your call side showing a gain. And if the opposite is true, if the stock price actually goes up, you're going to see your call side possibly showing a loser and your put side showing a winner. So what's important to realize is that with range-bound strategies, you want the stock price to stay within the short strikes, because at expiration, really what we want is for all of these strikes to expire out of the money. So we're selling it out of the money call spread here and selling it out of the money put spread here. If the stock price stays within the short strikes here at expiration, all 4 of these contracts will expire worthless, which is going to create the same scenario as our previous strategies. We're going to be able to take that credit that we received and use that as profit now, because all these options would disappear and we'd be able to allocate that capital elsewhere in different trades. So this is a strategy that we would use for non-directional trades. So when we're looking at a short put and a short put vertical, ideally, we want that underlying to go up. We do have the ability to be successful if it does not go up. It can stay the same, it can go down just a little bit, but ideally we want it to go up. Whereas with strategies like this, we actually want it to stay right in this range. So we're going to be happiest if the stock price stays right around this level here. It can go down a little bit or go up a little bit, but ideally for us to be able to close this out or buy back this spread for a lower amount, we're going to want to have that stock price stay right near the middle here, because then we'll start to see a winner on the call side and a winner on the put side, which is really what we're looking for. But let's wrap all this together with some takeaways for you. So the very first takeaway we've got is that if you focus on just a few strategies and master them, you're going to be putting yourself in a better position than if you spread yourself too thin. It's just like anything else. We have the ability to create an infinite amount of option strategies because we can create things like ratio spreads, front ratios, back ratios, jade lizards, strangles, straddles, you name it. But if you want to focus on just a few beginner strategies and really master them, what you'll learn is that a lot of these strategies that are more complex are just combinations of these things. So a ratio spread, for example, is just a combination of a long spread and another short option. Same thing with the butterfly. It's just a combination of a long spread and a short spread, where the two short strikes are sharing that same strike. So once you master these simple basic strategies, you can use them to combine and create other custom strategies for yourself. And at the end of the day, the real learning is going to take place when you're actually trading. We can go through all the textbooks in the world, but once we start trading and we start to see these things live and breathe and change as implied volatility changes and the stock price changes, that's where the real learning will take place. So understanding these concepts are going to be putting us at a better position to really make our own strategies and create our own custom strategies for whatever results we're looking for, whether it be income or cash over time, or just taking on a little bit of risk by selling very far out of the money strangles. Whatever it is, understanding these basic strategies are going to be able to put us at a better position than if we weren't to master these basics. So thanks so much for tuning in. If you've got any questions or feedback, shoot me an email here, or you can follow me at DoTraderMike. Stay tuned though, we've got Jim Schultz coming up next.